Today, I want to talk about how Elon Musk might be teaming up with Adam Aron and AMC. We know that Elon Musk himself wants to go after Wall Street and those short sellers, but it turns out he may not just be building a team of lawyers, but of CEOs as well. So stay tuned and let's make some money. Now I want to dive straight in with the key information. So, we know that Elon Musk wants to go after these short sellers and go after Wall Street, as he tweeted this just a few days ago. He said Tesla will continue to use outside litigators, but it's important to build a powerful litigation team internally so that we're not always on the defensive. He said we'll also go after Wall Street short sellers, certain law firms, and sometimes corrupt regulators who are true evil. This is after Brandon Earhart, General Counsel and Corporate Secretary of Tesla, posted on LinkedIn asking if you're an experienced partner at a top law firm. He asked, do you enjoy handling sophisticated litigation and trials, but are frustrated by internal issues like conflicts and passing on work for clients you love? He said Tesla Legal is building something unique, a full-scale internal litigation and trials team that can handle all aspects of litigation and trial work, including briefings, hearings, discovery, depositions, and trials, completely in-house. Now, Elon Musk also posted last year saying that buying Twitter is just an accelerant to creating X, the everything app. Elon Musk clearly sees more for Twitter than just a social media platform. He effectively wants Twitter to do pretty much everything. Maybe Twitter will turn into a social media platform combined with an investing platform combined with games and pretty much everything else under the sun. And Elon Musk has taken his next step into this plan. He's now re-registered Twitter as X Corporation, and Twitter Incorporated no longer exists. This legal filing states as follows: Twitter Incorporated has been merged into X Corp and no longer exists. X Corp is a privately held corporation incorporated in Nevada and with its principal place of business in San Francisco, California. Now, you may remember that last week, Adam Aron tweeted about the incorrect AMC data he's seen on multiple investing platforms. He said, update 1 week later on, the incorrect posts of our market cap and number of AMC shares and ape units. Sheer something 7-letter word rhymes with ducking, incompetence at irresponsible data services. Now, in my time, I've seen many ways to spell this something word. You could use the letter F with a number of stars after it. You could pretty much type the whole word and replace 1 or 2 letters with stars, or you could just star the entire 7-letter word. However, I've never really seen a combination of stars, X's, more stars, percent signs, exclamation points, more stars, and further exclamation points. You could use all stars, all X's, all exclamation points, but it just seems really weird to throw in this specific string of characters, especially with a percent sign in the middle too. But if you Google that word exactly how Adam Aron presented it, it takes you to X, the Moonshot Factory. It says that X is a diverse group of inventors and entrepreneurs who build and launch technologies that aim to improve the lives of millions, even billions of people. They've said that our goal is a 10x impact on the world's most interactable problems, not just 10% improvement. He said we approach projects that have the aspirations and riskiness of research with the speed and ambition of a startup. And X's plan is choosing to go to the moon. Now, I could only imagine the kind of person that would head up a group of inventors and entrepreneurs who build and launch technologies, such as the same person that might head up SpaceX, a company that launches spacecraft specifically to the moon and other areas of space. And that same person that heads up SpaceX and a diverse group of inventors and entrepreneurs would be none other than Elon Musk. So it seems that Adam Aron could be hinting that he is part of this team of inventors and entrepreneurs who build and launch technologies alongside Elon Musk. Either way, whether Adam Aron is involved in this plan or not, it will be super interesting to see Elon Musk going after Wall Street and going after those regulators too. Something that's also very interesting, especially after my video from yesterday, we're now already seeing AMC at potentially a new all-time high borrowing fee across the board. So far, the cost to borrow maximum is again over 1,000%. The cost to borrow average is also at 960%, and the cost to borrow minimum is at a whopping 955%. I don't know if this is yet a new all-time cost to borrow maximum, but it's for sure a new all-time cost to borrow minimum. We have seen a cost to borrow maximum fee, I think over 1,000% before, but I think at that time the cost to borrow minimum was lagging somewhere around 300 or 600%. So it seems after Bittrex is closing down its doors, AMC is already hitting a new all-time high for its cost to borrow fees. Again, AMC is just getting even more difficult and even more unrealistic for these shorts to continue shorting AMC and paying this sky-high borrowing fee. It's not just like one or two shorting companies is paying 10 times their total position in annual borrowing fees. It's basically every single shorter out there, as the cost to borrow minimum is at 955%. Therefore, every single fund that is currently shorting AMC is paying at least 9.5 times their total position in simply annual borrowing fees. You also have additional fees on top of that for kicking the can and rolling those total return swaps, kicking the can and rolling those put and call options, and also paying fines on top of that for any fail to delivers incurred. Now, something to make it even more difficult for these shorts to continue borrowing AMC is to be careful which trading platform you're currently using and whether they're lending out your shares or not. As Catherine has just tweeted, she said, confirmed, Wealthsimple does indeed loan out your shares if you do not opt out. She said they force you to agree and then you have to go in and turn it off under the hidden settings. She was speaking to a virtual assistant at Wealthsimple asking if she has to click agree on the share lending terms. And they've said that's right. The agreement is acknowledging this new feature and by default it turns it on. They've said it takes 5 days to loan out shares though, so you can agree and immediately opt out after. But they said you do need to agree to have the agreement stop popping up. Again, this is really sketchy that they force you to agree to lend out your shares, but then say you can turn it off later. I'm really worrying if they actually ever stop lending out your shares. Even if you're not consenting to it because you previously had consented and they had lent out your shares at that point, they may just say that your shares are already on loan, and unfortunately at this time we can't stop lending them out. And that's why I do think if you haven't already, it's probably best to transfer off of platforms that lend out your shares to other trading platforms like Moomoo, for example, which is linked in the description below. Now, I also wanted to talk about where we currently are in terms of the next leg down of the stock market crash. As Holger has tweeted, he said hedge funds have boosted their S&P 500 shorts to decade highs before CPI and earnings. It says that net short positions are at levels not seen since 2011. Currently, these hedge funds and effectively all institutions are shorting more shares than they were even back in March of 2020. And on top of that, Goldman's clients are cutting tech longs and tech exposure at the fastest pace in 15 months. You may have seen since January the S&P 500 has rallied off its lows or rallied off its higher lows. I think I read somewhere like 90% of this current rally has been built only from the 7 largest stocks. Basically saying the current year rally since January has only happened because of Nvidia, Apple and a few other select stocks like Tesla and Facebook, which is basically suggesting that the current rally is not sustainable because other stocks aren't following that same pattern. And therefore, as soon as Nvidia, Tesla, Facebook and Apple reach their higher high, they will turn around, reverse and come straight back down. And that's why Goldman's clients have been cutting their exposure to long tech positions like Nvidia, Apple and Tesla at the fastest pace in 15 months. And if anything, these hedge funds have been flipping short as they know exactly what's about to happen and they know the market will fall further. And Sam tweeted saying the only reason they've been able to keep the S&P 500 around this 4,000 point mark has been extreme suppression of the VIX. So the VIX is obviously the volatility index, and when we see higher volatility, it usually means the market is falling. Therefore, by suppressing the volatility, the market effectively doesn't fall. And he said this is the limit. They can short UVXY, which are VIX futures, a few pennies here and there, but it keeps popping up. And he said the second they lose control of the VIX, or effectively the UVXY, the market crashes faster than you can say help. And obviously, if the market does indeed crash and crash heavily and crash fast, it means these hedge funds will not have enough time to escape their long positions and will end up going bankrupt. It means many of these hedge funds that are currently long on the overall market but short some specific stocks like AMC, for example, will end up going bankrupt on their long positions. And when these hedge funds effectively get liquidated and go bankrupt from their long positions, they'll be forced to sell off those long positions and close out of their short positions too. Effectively, these hedge funds will fail margin calls and will be forced to close out of their positions to satisfy margin requirements. And something else we also saw yesterday, as tweeted by Bigums, is that Goldman Sachs has just paid a $15 million fine for total return swap disclosure violations. We know that total return swaps are what our kohrs was using and what many other hedge funds are using to short AMC, effectively shorting AMC indirectly through that total return swap. And it seems that Goldman Sachs has not been disclosing these appropriately. It says that Goldman Sachs has agreed to pay $15 million to settle CFTC charges that have failed to make proper disclosures and communicate fairly to swap customers, the regulator said on Monday. Goldman opportunistically sold clients on so-called same-day swaps at times that financially benefited the bank and hurt its customers. And by depriving clients of transparency into the relative value of the swaps it was offering, Goldman violated CFTC's business conduct standards for swap dealers. Again, while it is good that banks and financial institutions are being caught for breaches of regulation SHO and breaches of swap disclosure regulations too, I still don't think that it's good that they're only being issued small speeding ticket fines. I do think it's good that regulators are now investigating regulation SHO, naked shorting and swap manipulation, but it's not good that these companies are only still being fined. The only way the regulators are ever going to settle this issue is by sending many top executives to jail. But obviously so far it seems like that won't be happening, likely because the regulators are in bed with these major financial institutions. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.